Good evening, everyone. Thank you for joining into today's webinar. My name is Jyotak Nandwana and I'll be hosting the webinar for you. So our topic for today is how to identify the next set of leading stocks. I think it's quite relevant to the current market condition, and we thought it's a good time to refresh our knowledge on what are the indicators of a leading stock. So before we begin, I would like you guys to spend some time on reading the disclaimer. So it says the stocks that we'll be discussing today, those shouldn't be considered as recommendation to buy or sell. All information is intended for educational purposes only and in no way should be considered as investment advice. All right, so this is going to be our agenda. As always, we'll spend some time on discussing the current market condition. Then we'll move on to the main topic for today, that is how to identify the leading stocks. So we'll discuss about what's the importance of relative strength. How do you distinguish between market leaders and laggards using relative strength, and also confirm whether a breakout is a strong one or not during market uptrends, and how do you use RS during market weakness to build your watch list. Towards the end of the session, we'll have a dedicated Q&A. So I would request all of you to reserve your queries for the Q&A session. However, if in case you have any question that is very relevant to the current topic of discussion, you can always use the chat box to raise a query. Right, so let's begin with the current market conditions. So this is how Nifty is shaping up. This is the daily chart of the Nifty index. The market has been in under pressure since May 18th. So if you look at the recent chart, that is the high that the Nifty had made. So the high was made over here, and this was around late January. And since then, the index hasn't done much. So we have had a highly volatile period where the market has been trying to go up. However, it either faces resistance at its 50 DMA level or the overhead resistance kicks in, and since then, the index has been facing resistance around the 10,930 levels. So on the downside, we can see that the 50-day moving average is serving as a crucial support level for the index. Now, today was a very interesting session for the market. So we had the underperformers of the past, so that is the pharma sector, leading the rally in today's market, and we saw the Nifty closing at a 4-month high. So it closed around levels of 10,850, and now we are watching the 10,930 level very closely. So that's the key resistance level, and once that is taken out, it will signal that we could be in for a short-term good performance. Okay, just want to check if you're able to see the slides or not. You can reply in the chat box. All right, so I think users who have joined in from using mobile, they might have trouble reading the numbers, so don't worry about that. Yeah, I'll be anyway letting you know all those numbers while talking, so you don't have to worry about that. Apart from that, if in case the voice is not clear or if you're not able to hear me, so I'll just quickly type in a message for you. It's better to re-log in. It could be mainly because of internet connectivity issue, so there's no problem from my side over here. All right, so we'll get back to the webinar. Right, so I was saying that once the key resistance of 10,930 is taken out, we could be in for some interesting time. However, we would also like to see institutional activity picking up, because right now what we have seen is since the month of April, the FII selling has been huge. So I think in the month of April and May, FIIs had withdrawn from the equity markets close to 20,000 crores. So that's a huge amount of money that has already been taken out from the markets. And currently also, even in the month of June, we are not seeing a lot of FII buying happening. So in fact, the selling has been continuing, and the inflows from domestic institutional investors has been supporting the market. Right. Now, even in this market, which has been quite volatile and hasn't made much progress in the last 4-5 months, we have seen select pockets that have been doing well. So as I said, pharma has been doing well recently. So in the past 2-3 sessions, we have seen quite a lot of interest building up in some leading pharma stocks. And apart from that, select financial stocks, so mainly in the private space, as well as consumption related stocks have been doing really well, while the market has remained under pressure. So that's a quick snapshot of how the market is looking right now from a key index perspective. So it's in under pressure, and the distribution day count, which keeps a track on institutional selling, it is not too high. It's at a comfortable level of 2 on Nifty and 3 on Sensex. Now in the mid cap and small cap, so these are the places where the pain has been huge. So while both Nifty and Sensex, they are still close to their all-time highs, I think around just 2 to 3% away from their all-time highs. But the Nifty mid cap and small cap have corrected hugely, and that's the reason why you must have also seen your portfolios witnessing some drawdowns if you're highly exposed to mid cap and small cap stocks. So for the Nifty mid cap, right now the market status is rally attempt. It has been able to establish a bottom for now. So there's a strong support coming around the 18,000 levels. And if you see from the chart, you can see that it's trying to move back up again, but there is a huge overhead supply. The index is yet below its 50 and 200-day moving average, and it will have to retake a lot of overhead supply for it to move higher. So the current overhead supply of 13% indicates that the index has corrected 13% from its January high. So that's the 52-week high, also the all-time high. Now, in the mid cap and small cap space, what we have seen is the number of stock breakouts have dried up. So there has been a complete dry up in the number of stocks that are breaking out on a weekly basis. We have a slide on that as well, where we'll showcase that how the breakouts have panned in the last few weeks. So overall, we still don't see strength in the mid cap space. Of course, they have done well in the past few sessions, but we will wait for a follow-through day to give us a confirmation that a bottom has been established and we could be in for an uptrend. Right. Next up is Nifty small cap. Again, quite similar to what's happening at the mid cap level. There was a strong update on Nifty small cap, by the way. So it happened on May 25th, and the index had moved up 1.5% on greater volume. So that was identified as a follow-through day. However, it failed, and the index pulled back again and went on to make breach its previous low of 7,600. So again, it has kind of established a bottom, and it has found support at the 7,200 levels. Also, the 52-week low of 6,900 is kind of is something which most investors are looking at. So looks like from the daily chart, it looks like it has some good support over that level. But again, if you look at the volumes, the distribution has been high in recent times. The overhead supply is 20%, so it has corrected 20% from its all-time high. And the volumes that are coming when the index is moving up is also not that great. So you can see there's just one day of above average volume. Apart from that, all the updates have come on below average volumes on the chart. Now, again, in terms of breakouts, we don't see a lot of stocks that are breaking out from the small cap index. One or two stocks here and there. Okay, so I think few users are still facing issues with respect to voice, and you can drop in a message if you're not able to hear me clearly. I think most of you can hear me clearly, so I'll resume the webinar. So in terms of breakouts also, we are not seeing a lot of stocks that are, breaking out of base patterns from the small cap space. So both mid cap and small cap continue to look weak right now. But the good thing is, in the short term, we see that they might have formed a bottom. So that's one good thing. But we also want a confirmation in the form of a follow through day. All right, so images are blurry, so request you to re-log in. It could be a connectivity issue. Right, so moving on, we have the breakout statistics over here. So these are the number of stocks that are breaking out on that have broken out on a weekly basis. So a quick look at it will tell you the story that how from a point of strength during April, we have come down to a point of weakness where the number has gone down to single digit. So something similar had happened during the period of January to March as well, when we did not have many stocks that were breaking out. And so that was the period when a lot of leading stocks were actually forming bases, and most of them actually broke out when the markets turned up again during April. However, this rally couldn't be sustained and they're back at building bases once again. So the markets have been very choppy, and because of that, we are not seeing a lot of stock breakouts that are working. There are exceptions, and that's the reason why we thought that it's a very good time to look at how to identify the next set of leading stocks, because all those exceptions will be in the space of leading stocks, and that's the reason why we need to be prepared and aware of the factors that we need to look at identifying leading stocks. So as a simple logic, just keep a couple of things in mind. When we talk about leading stocks, we want stocks to be leaders in terms of both earnings and price performance. So everyone knows that in the long term, it is the earnings because of which stock prices go up, right? But in the short term, we can also have prices moving up. Now, if those prices are not backed by earnings, there's no point, wasting time over there, because it's not sustainable. If the company is not able to meet street expectations, if the company is not able to report good results, the stock will come down. So keep your focus on earnings, and once you have identified, once you have screened all those good quality stocks in terms of earnings, the next step is to identify the leaders in terms of price performance as well. Because a lot of time what can happen is, suppose you narrowed down to a stock, you think that it has a great business model and it should do well over a long period of time. But the point is, what if the stock doesn't move? What if the stock doesn't do much over a period of say 1 year, 2 years? So in case of Reliance, we had when the stock did nothing for more than 5 years, right? And now suddenly, I think last year it started rallying and is now very close to its all-time high again. So make sure that you're not wasting your time also in stocks which are not doing much, and you're deploying your capital there, and in turn you're not getting much for say 1 or 2 years because it keeps moving sideways. So that's where relative strength comes in, and that is why relative strength is important. So just to brief you, relative strength is a stock's price performance in relation to the rest of the stocks. So relative strength basically helps you in separating leaders from laggards. So as I said, there can be times when stocks do nothing, they move sideways. So make sure you're not getting into them at wrong period of time. Of course, they must be good in terms of fundamentals, but you also want to make sure that when you get into it, it's not a value trap and it remains sideways for a long period of time. So that's where relative strength will help you, because it separates leaders from laggards. Now, RS rating of 99 means that it has outperformed 99% of stocks on price performance basis, right? Now, in relative strength rating, we look at a price performance over a period of 1 year, but we pay a more weightage to, we give more weightage to the recent performance. So recent quarter performance is given more weightage, right? So there's an interesting quote which I could get from the Market Wizards book. So it's by David Ryan, who was a former portfolio manager with William O'Neill. So he says, I would rather go with a relative strength of 99 than a 95, because many a times the relative strength takes off before that big earnings report comes out. So even you must have noticed in the Indian market that much before the earnings is out or much before the results are out, the stock starts rallying. So of course, those are exceptions, but at times what happens is, if you have narrowed down to a stock in terms of past earnings performance, it has a very good earnings quality, its sales and earnings are growing at a fast pace. So once you have narrowed down into it, next what you need to do is look at the relative strength, how it is moving, and whether it is showing signs of leadership or not. So once that kind of a stock breaks out, you always need to put in your money there, because it's leading not only in terms of price performance but also in terms of earnings performance. Now, the reason why relative strength is very important is because we have thousands of stocks in the Indian market. Now, as retail investors, as individual investors, we don't have the time to look at each and every stock. So that's where relative strength will help you. So once you have screened stocks on the basis of earnings performance, the next step is to screen stocks on the basis of relative strength. So it will allow you to focus only on those stocks that are showing superior price performance, that are in demand, and that are doing well in the market. Okay, so I'll just quickly type in a message for people who are having trouble listening in. We'll upload the recording of today's webinar on our YouTube channel as well as on our blog. All right. Now, where is the relative strength rating located on MarketSmith India chart? So most of you must be aware of this, but I thought that for new users, I'll just quickly show up. So you can see just underneath the most recent price bar, there is a small number close to the blue line. So that's the relative strength rating. I have marked it over here. There's a zoomed in chart as well. So it says 90. So this chart is of Bajaj Finance, and it has been one of the leading stocks in the current market. And it's a very good example of how leading stocks can save you when the market is in a downturn or when the market is not doing much. So when the market is not doing much, or when the market is facing a correction, so again I'm talking more from the perspective of the broader market. So when you look at Nifty and Sensex, you might get carried away with what correction, nothing has happened, index are just 2-3% below all-time highs. But when you look at the broader market, a good amount of correction has happened in the mid cap and small cap space, and the smart money, the money has moved mainly into quality companies over this period, and that's the reason why we see a lot of quality stocks which have some proven business models which are still growing at good pace, such as Bajaj Finance, Nestle India, Avenue Supermarts. They're continuing to do well, and they're continuing to hit new highs again and again. So you can see the relative strength rating, it stands at 90. So it says that it outperforms 90% of all the Indian stocks. Now don't get confused with the blue line. The blue line is the relative strength line, and there is a difference between the relative strength line and the relative strength rating. So The difference is that relative strength line actually compares the stock's price performance versus the benchmark. And on the other hand, a relative strength rating is relative to the performance of all the other stocks in the Indian market. So the line compares it with the benchmark, while the relative strength rating is versus all the other stocks. Now, an upward sloping line means that the stock is outperforming the index. Now, if we go back again, you will see how Bajaj Finance relative strength line. So again, the blue line, which you can see at the bottom of the price bars, you can see how it, kind of went down. So this was a period of underperformance, and that's the time when the stock did nothing. So it built a double bottom base pattern. Right. So once it broke out, you can see how the relative strength line almost came near its previous high, almost touched a 52-week high. And once the results were out, so the company reported really good numbers in Q4, and again it broke out of a small short base pattern. Again, the relative strength line, in fact, this time around it almost touched its all-time high. So you need to make sure that once you have screen stocks on the basis of both earnings, that is EPS rating, and relative strength rating, just try to understand how the relative strength line is moving. Is the stock underperforming or outperforming the overall market in the near term? Now, ideally, you would like to have a scenario where a stock, when it breaks out, also sees relative strength line touching a new high. So we have one more example which I'll share, and it's the signal of immense strength when that happens. Right. So relative strength line is mainly used in two ways. First is that to confirm that a leader is breaking out. Now, as I said, when a stock breaks out, if the relative strength line is touching a new high, or if it is touching a 52-week high, that's a confirmation that a leader is breaking out. Now, apart from that also, during market correction, you'll be able to see how the relative strength line is moving. So now whether it is showing strength or not. So it will show strength if the relative strength line starts hitting new highs much before the stock price. So that can also happen. And if you see a sudden turn, a sudden, a pullback, a sudden turn in the relative strength line before the stock breaks out, make sure that you're keeping an eye on that stock. Now, this is an example of what happens when a leading stock breaks out. Now, VIP Industries is a mid-cap stock, but this stock has, faced no correction. In fact, when the market was going down, this stock silently built a new base pattern, not with a much base depth. So from the highs of 441, it corrected to 365, but then it again had a good bounce from its 50-day line. So again, showing characteristics of a leading stock, good support at 50-day line, not correcting much when there was carnage in mid cap and small cap stocks. You can see how the relative strength. There were a couple of days when it did go down, but apart from that, it mostly stayed sideways, right? So you can look at here and look at here how it stayed sideways. And once the stock broke out of the base pattern, it hit a new high. Correct. So it was hovering around its all-time high, the relative strength line, and the RS rating is also good at 95 right now. But the relative strength line surely gave you signs that the stock is in huge demand. You can see that from the volume. So all those things will need to be used in harmony, and this will give you a very good confirmation. So once you see that a stock, you have narrowed down that a stock has good earnings and good relative strength, and its relative strength line is close to its all-time high or near its 52-week high, just keep an eye on whether the stock is being accumulated or not. So of course, the accumulation distribution rating, that is the buyer demand rating, will help you in giving an idea whether a stock is being accumulated or not. But those huge volume bars on the upside, so huge blue lines, skyscrapers in the volume chart, will give you an idea whether it's being accumulated or not. All right. So a very good example of how to identify whether a leading stock is breaking out or not. Now we'll also have an exercise where I'll try to show how you can use MarketSmith India to find leading stocks. So basically what you need to do is only filter stocks that have strong EPS and RS ratings. And the next level is that you don't want stocks to have a high overhead supply. So with overhead supply, I mean the difference between the 52-week high and the current price. So you don't want a stock to be, down 20-30%, because when a stock is down 20-30%, it has most probably breached its 50-day line, could have also breached its 200-day line, and it could be in for some consolidation. So you don't want to get into a stock which might move sideways for we don't know how long. It could be 1 month, it could be even 1 year also. So make sure that you're only screening stocks which have low overhead supply. So I like to keep it around 10%, so not more than 10%. So stocks shouldn't have corrected more than 10%, and that's a very good plus point, especially in the current market, because when we have seen mid cap and small cap, so mid cap is down 13% and small cap is down 20%. Now those indices are down at such levels, and if you are able to get a good quality stock that has not corrected more than 10%, so that is showing signs of leadership. So make sure you get you favorite that stock, you get that into your watch list, and I'll take you through that process also once we are done with this. Also, there should be a high buyer demand rating. So we saw in the case of VIP Industries how those huge blue bars were showing signs of accumulation. So once you have screen stocks only with say buyer demand rating of A and B, that will only show you stocks which are witnessing accumulation. Now then you need to sort it from high to low RS rating. So again, only concentrate on leading stocks. So once you have got the results, make sure you're sorting it from on the basis of relative strength rating, that is high to low. And then you need to closely watch the stock's action to understand its movement relative to other stocks and overall market. So when I say other stocks, you're using the relative strength rating, and when I say overall market, you're using the relative strength line, right? All right, now, so putting into practice, always review the relative strength rating for stock candidates. So suppose if, say someone has said that, this particular stock is looking very good, make sure that you're looking at where does the stock stand in terms of relative strength rating, because there's a difference between a good company and a good stock. Over a long period of time, every good company will have a good stock, but in the short term, not every good company will have a good stock, right? So in the short term, there can be underperformance by good companies. So that's the idea behind using relative strength rating. We don't want to get invest in those companies which are going through consolidation phase. Then sort list by RS rating to reveal which stocks are leaders, and look for the RS line making new highs when you're reviewing the results. All right, so I'll take you through that exercise, and at the end we'll have a Q&A session also. All right, so this is the home screen of MarketSmith India. Now you need to go to Idea List. This is the place where you can filter stocks. So go to Filter India Stocks under MarketSmith Stock Screens. So I have already applied a filter over here. Let's look at what I have done. Okay, so now what we need to do is we are just looking at leading stocks. So earnings trend should be good and great. So I'm just limiting to those two ratings. Price trend should be again good and great. You can play around with it. So if you're getting a lot of results, you can always just focus on the great stocks. So for now, I'm keeping both good and great. Next up is, right, so what kind of market cap you're looking at. So for now, I am market cap agnostic. So I'll not have this filter right now. It could be from any space. Average rupee volume is important because liquidity is very important while investing. So I'm looking at 50-day average rupee volume of at least 60 lakh rupees. Next up, we have off-high. So this is something which I discussed. This is the overhead supply concept. So I don't want stocks to have corrected more than 10%. So that's the reason why I have put these two over here. You can also include an additional ROE filter. So that will only give you results of fundamentally strong companies. So I'm keeping it at those 3 ratings right now. All right. So let's see what are the results that we are getting. So we are getting only 31 stocks, and those are the ones. And now what you need to do is look at those stocks, study their charts, and see how the relative strength line has been moving. And also it will give you an idea as to, if you evaluate it from an overall canceling perspective, what you need to do is quickly go to the checklist and see whether it's meeting all the criteria or not. So Bajaj Finance, it's meeting most of the criteria, and it's one of the perfect canceling quality stock, and has seen a huge run for a lot of years now. With Bajaj Finance, like when we had recommended it to our users, so there were a couple of reasons why most of them did not buy it, right? And both reasons are, if you think about it, are not very logical. So one of the reason was it has already gone too high. So now that's a kind of bias, because we have seen this stock for years. So Bajaj Finance has been a stock market darling for 5, 6, more than that, right? So we have been seeing it for more than 5, 6 years, and we have seen how the stock has rallied from levels of 1500 to, so it's the split adjusted price, so 150 to almost 2000, right? So that's happened in the last 5 years. Now, when you have seen a stock going up from 150 to 2000, the first thing that comes to your mind is, why should I buy it now? I missed it, and let's not focus onto it. But what you need to keep in mind is, don't concentrate on where the stock has come from, concentrate on where the stock can go from here, right? So that was one of the reasons why few users didn't buy the stock when we recommended it. And another reason which I came across was that it's a high price stock. Now that again, many stock market participants who are quite experienced will agree with me that price is something which shouldn't impact your investment decision, because at the end of the day, the number of stocks that you buy doesn't matter. It's the capital that you invest, right? So if you're investing 50,000 rupees, you need to look at it from that point of view, that how much that 50,000 can turn, can appreciate from here. So don't worry about the number of stocks that you're getting, number of shares you're getting, because that is not something which will determine your investment result. So Bajaj Finance is up around 18% from our ad price. So looking at how the overall market has performed, it's given quite good amount of return in the current market volatility, and also could have saved a lot of portfolio performance. So that's about Bajaj Finance. So once you have screened all those stocks, the leading stocks, both in terms of earnings and relative strength, all you need to do is how's the relative strength looking? How's the relative strength line looking? Is it making new highs or not? So Quest Corp is also another stock where you can see that the relative strength line is almost at a new high. But then you also need to look at how the volumes are coming. Now, when I look at the volumes, you can see that there is a certain dry up over here. Buyer demand remains good, so that's something which is strong. But when you look at volume, so you can see that there was a dry up over here. It has picked up in a couple of sessions, and let's see if it can move further higher. So that's something which where MarketSmith India can help you. So all you need to do is filter those stocks, and you can also add additional screens to make sure that you're just restricting yourself to only quality stocks and remove away the laggards. So you can add the buyer demand as well. If you can also think about restricting your criteria to only top leaders. So even in terms of group rank, also they are the top leaders, and then you can see that how many stocks are coming up. So we don't see many stocks. There are just 11 stocks over here, and then all you need to do is, so most of the stocks that you will be seeing right now are ones which are quite popular in the market, are established names, are well proven business company, well proven business models. And the reason for that again is that this market is favoring only quality companies. This market is, if you see the stocks that are making new highs on a daily basis, we don't see a lot of stocks that are making new highs on a daily basis, but if you see the list, you'll find out that only the quality ones are making new highs on a daily basis. So that will give you an idea as to what kind of market we are in right now. And the few ones which I continuously see that are making new highs, as I had mentioned before, are Bajaj Finance, Nestle India, Avenue Supermarts. VIP Industries is one of the exceptions that have shown a lot of strength from the mid-cap space. Right. So that was about it. And now let's move on to the Q&A session. And you can start pouring in your queries using the chat box, and I'll be happy to answer them. So we have good amount of time, and we have been able to wrap up the session and giving us some room to hear your queries. So it will be great if you can keep the queries coming in, and we'll be happy to answer them. Okay, so the recording of the webinar will again, as I said, will be available on our blog and the YouTube channel in some time. Okay, so I'll be getting a lot of stock queries, and it could be possible that I miss some of them. So in case if I don't answer your query, make sure that you're posting it again, and I'll try to answer as much as possible. Okay, so there is one query from Dipankar regarding RS rating and master score. So what significance of master score versus RS rating? So Dipankar, master score is a composite rating. Master score looks at not just the price performance, it also considers overall earning strength of the company, the buyer demand, so that's the accumulation distribution, how is the company in terms of industry group rank. So it takes into account multiple factors and then assigns a composite rating. So if you want to look at a stock that is great in terms of all of those individual ratings, make sure that you're keeping a very high benchmark for your master score. Okay, so is there any difference between RS line and RS index? So RS line, as I said, is mainly looking into so we have a proprietary method by which we calculate the RS rating, and the RS line looks at the price performance in the last 1 year, and it compares it with the benchmark. Okay, so quite a few queries coming in. Right. So how is First Source looking right now? So I'll pull up the chart and we'll discuss it using MarketSmith India. All right, so First Source Solutions has seen a huge run up after breaking out, and the stock has done really well. From levels of 50, it has gone up to 82. So that's a great performance considering the overall market condition. Now, this is the time that when most of the people who have bought the stock will be thinking about when to sell it. Now, it's a tough call because the stock is hitting new highs again and again, and of course one could take a call by selling into strength, but then when the stock keeps going up, there will always be a regret. So what I would suggest is make sure you are keeping an eye on how much the stock has advanced from its 200-day line. So one of the selling rules which William O'Neill has advocated is if a stock advances 70 to 100% from its 200-day moving average, so you consider selling it because it is too extended now, and there is a high probability that the stock could, pull back and make a new base pattern. So right now I can see that First Source is 69% above its 200-day line. So from 200-day perspective, it is looking a bit extended. But what you need to do is, now today you saw that the stock hit a new high. So I wouldn't be running to sell the stock right now. Of course, I have at the back of my mind, I know that it has extended from its 200-day line. So what I'll do is, one thing you can do is you can keep a trailing stop loss of 10%. So from the high, if it corrects 10%, you're out of it. The other thing that you can do is, if you see a reversal, if you see a downside reversal, that is a negative reversal. So after hitting a new high, if the stock comes down, if it faces profit booking and it comes down and closes near the day's low and the volume is also high, you can consider getting out of it. So that's one of the weak signals, and that is something which we had also discussed in the previous week's learning article, how downside reversals are a good indicator of selling a stock. All right. Yeah, so there is one query on regarding model portfolio. So from Achal, so we had recommended a lot of stocks during April. So yeah, as I had showed you that the breakout statistics which we had, you could see that a lot of stocks were breaking out in the month of April. The Nifty small cap, mid cap, all those indices, even the frontline indices, Nifty and Sensex, all of them had given a follow through day, and the market was in a confirmed uptrend. But as I said, there were few mistakes that had happened, and we have discussed all those mistakes in the learning article which we shared previous week. So I think one of the mistakes that had happened was that we recommended a few stocks from mid cap and small cap space, right? And what we saw was that the rally didn't have legs, and the mid cap and small cap indices corrected heavily even after going up a little in April. So they corrected heavily. There was a lot of selling pressure. There was distribution happening in those indices, and a lot of stocks that we had recommended actually faced profit booking and couldn't go higher, even though they had reported really good results. Now, that's the thing which happens when the overall market sentiment is weak. So even if you have bought into a fundamentally strong stock, the company has reported really good results in Q4, even then the stock failed to move higher. In fact, it faced profit booking. So it was a really weak market, and that has been our biggest learning over the last 3-4 months. When the markets are choppy, it's always better to stick to quality stocks. So by quality, what I mean is, of course, the ones which we had recommended, all of those were fundamentally strong. But by quality, what I mean is the ones which are in the large cap space, the ones which have proven business models, the ones which have sustainable earnings growth and are not facing a lot of correction in the current market. Okay, so next query is from KN. I see a couple of queries. One is Jubilant Foodwork, the other is Apex Frozen. So I'll answer both. So let's take up Jubilant Foodwork. Right, so looking at Jubilant Foodworks chart, what I can see is that the stock has some really good support at its 50-day line. So there are a couple of occasions when the stock has bounced back from there, and again it has happened right now. So again, the stock is near its all-time high. I'm not sure if it touched, I don't think it touched a new high today. So one thing what you can do is, again, if I look at from a moving average perspective, the stock is not too much extended. It's just 38% above its 200-day line. And you can always use the green range over here. So this denotes the profit booking range. So once the stock has gone up 25%, 20-25% from its breakout, consider booking profits because the stock could be in for some consolidation. So that's according to our research of historical biggest winners. Once a stock, after it breaks out, it rises 20-25%, builds a new base, and does the same thing again. So make sure that, so there are a couple of things that you need to keep in mind. One, you can sell into strength by booking profits at 20-25% level from the previous pivot price. So that is 2,330. The second thing is, if the stock is unable to retake its previous high, so that is 2750, and it faces profit booking again, so you can of course use that as an opportunity to sell. But then again, there could be a chance where the stock finds support again, its 200-day line again moves up and goes above your selling price. So those things can also happen. So for me, I would be happy with a 20-25% profit once it enters the green range. Right. So next was Apex Frozen. So this stock has been witnessing some selling pressure and has actually breached its 50-day line as well. I think the overall sector is currently looking weak right now. So there are a lot of things which are happening in this sector which could, impact the financial performance of all those companies in the coming quarters. And that's the reason why, of course, and those stocks had given some great returns in 2017. So there's no surprise that, investors are kind of booking profits and moving on, especially when there are headwinds in the sector. So for Apex Frozen, the best point of selling would have been when it reached its 50-day line. Whenever a stock breaches its 50-day line, the reason why we recommend always selling a stock breaching its 50-day line is there are two reasons. The first one is a good quality stock will always find support at its 50-day line, because all those smart money managers, all those big institutions actually track the 50-day line very closely. They track the 50-day moving average closely, because once they see a stock is getting close to that, in order to protect their previous positions, they add on a bit more to their existing positions. So that's the reason why good quality stocks will find support at their 50-day lines. The second reason why you need to sell when a stock breaches its 50-day line is, first, because of course it didn't find institutional support. The second is that the stock could be in for some consolidation. Now we don't want to be in a stock that is moving sideways. Now if you look at Apex Frozen, I think around the levels of 730 it had breached its 50-day line, and now it has gone below 500. So even if the stock doesn't do much, what's the point of keeping your money when you can always use that in some the other leading stock? So for me, Apex Frozen would be a sell right now, because we don't know for how long the stock remains sideways. We don't know for how long, whether the stock has already established a bottom or not. There is a huge overhead resistance that it has accumulated. So there are people who have bought at levels of 650, 600, 550, 500. And when the stock tries to come up, the stock will face resistance from all those investors as they try to break even. Okay, so explanation needed on 200 days and the 70% profit booking rule. So suppose the 200-day moving average is 100 and the current stock price is 170. So the stock is 70% above its 200-day line, correct? So that's a rule that you can use, because when William O'Neill was studying all the past winners and his investment decisions, he noticed that stocks that have gone up 70 to 100% from their 200-day lines actually faced selling pressure, and they came down from those levels. 70 to 100% is 70 to 100% is the level which you need to watch out for. I think for first source it's coming close to that level, but again you need to also look at whether the stock is looking weak or not. So if there is a downside reversal, if it is unable to take its previous high, if it is facing resistance at its 52-week high and coming down from there, you can always get out of it. So next up is RBL Bank. So this is one of the stock which I have been watching closely. If you look at RBL Bank, of course, good in terms of fundamentals, and the stock is witnessing some accumulation now. You can see all those blue bars, and you can also see how it has gone through a long phase of consolidation. So that's the reason why I have said, so imagine if someone had bought over here, so that's a painful journey for that investor. For 1 year, the stock is not doing anything, and in fact, the person would be sitting on the loss, while other stocks have gone up, while market has gone, right? So that's a very painful journey. So anyway, coming back to the point, now if you look at RBL Bank, so there's a pickup in RS line, so it's outperforming the market. The RS rating is decent. 72 is not great, but it's not too bad also, considering the stock didn't do much last year. 552 is a level which needs to be watched closely. Of course, the all-time the long-term resistance is at 600 levels, which is looks like the all-time high. But 552 is a level at which the stock has tried to surpass on 1, 2, 3, 4, 5 occasions, and I think it's coming back to that levels again. So once you see that the stock is going above that level, you can consider it as an alternative buy point. Of course, it's not the ideal entry point because the stock still has some way to move up. It still has 9% to cover before it breaks out to new high ground. So that can be an alternative buy point, and you also need to have a exit rule in place. So suppose if in tomorrow's session RBL Bank breaks above 552 and you consider buying it, so what will be your exit strategy? You need to have some strategy in place for the ideal entry point. For the ideal breakouts, we always have an exit strategy of 8%. Now for this, you can have an exit strategy of say a 50 DMA breach or those kind of a thing. Okay, so next query is for Vishaka, Welspun Enterprise, and Shriram Transport. So I'll answer all of those one by one. So I guess Vishaka has reported some good numbers in recent quarters, and from technical point of view, so I don't have a lot of time to look at the fundamentals, but from technical point of view, I can certainly say that the stock is has kind of has formed a bottom, you can say, at the 587 level. So there are 3 occasions where it has bounced back from there. But again, so you can see how the concept of overhead supply is playing over here. As the stock tries to go up, again it faces resistance from all those investors who bought at previous levels, and it faces a huge task of coming over that resistance. Now it is below its 50-day, 200-day line. I wouldn't suggest getting into it right now. Wait for the consolidation to play out. It's a late stage base from the looks of it. So it's a 4th stage base. So it could be a long base because the stock has run up from almost 10 times in the last 2 years. So wait for it to consolidate, wait for all the weak hands to get out of it, weak investors to move out of it, and then you can consider adding a position into it. All right, so next query is from Sai on Exide Industries. Okay, so there are a couple of queries in between as well. So Welspun Enterprise and Shriram Transport. So Welspun Enterprise, after breaking out, in fact, it's a failed breakout. If you can see, the stock has not done much after breaking out. It has hit the loss range also. Of course, it has bounced back with the recovery in small cap and mid cap indices, but we need to wait for the stock to reclaim its previous high. It has seen a good run up from the levels of 50 to almost 200, and there could be some time before it moves higher. Now, if I look at the relative strength rating also, it's not that bad. We have seen some huge accumulation that has happened inside the base, so that's a positive signal for the stock. But the one thing that you need to keep in mind over here is from the low of the base, so from 140 levels, in a very short span of time, the stock ran up from 140 to 200. So those kind of breakouts carry high chances of failing because there hasn't been any shakeout. So we want from 140 levels, when a stock is going up to 200, in between, if there is a shakeout, in between, if there is some profit booking, that is something which we want to happen. So that has not happened for a year for this stock, and that's the reason why it could be facing a little bit of underperformance right now. But of course, keep an eye on it, and once it retakes the levels of 203, it could be interesting, especially if the market condition improves. Next is Shriram Transport. Yeah, I'm just checking whether I got the company's name correct. Yeah, Shriram Transport. So again, another case where the breakout has not worked. So that's been the story of the Indian market for the last 3-4 months, where not a lot of stock breakouts have worked, and the stock has failed. Many stocks have failed to trend higher after breaking out of a base pattern. So a similar thing has happened with Shriram Transport Finance also. From fundamental point of view, there were 3 quarters where the company did well. I'm not sure why the earnings have declined in the recent quarter. But from what I can see is that the stock is currently not even though it's in the idle buy range, but there's some little bit of overhead supply that it has accumulated, and it's not looking too convincing from chart perspective, because the breakout has failed and it has hit its loss range also. So I would wait again, because it could again face resistance at these levels and the previous high and the all-time high as well. So I would wait for the stock to consolidate further, and once that consolidation happens, maybe you can consider getting in, especially if the fundamentals are good. All right, so Abram, you can refer to our YouTube videos where we have covered all the features of MarketSmith India in detail. Next is a query from Amit on Reliance Industries. All right, so Reliance Industries is again witnessing some interest in recent times. So you can see that how the stock has moved up from its base low. Again, I would like to see a little bit of shakeout happening over here, because that's been a quick ride from levels of 900 to almost 1000. So it could face resistance at the level of 1000, which has been its previous high within the base, and the all-time high as well, which is 1011. So there is something new happening, which we all know with Reliance. The fundamentals are also improving, and that's the reason why the stock has rallied in the past 1 year. But you need to also keep in mind that the stock has built a third stage base pattern. So the probability of a stock success after breaking out from a third stage, fourth stage is bit on the lower side. Prefer first stage and second stage base pattern. Having said that, it's been a good amount of consolidation. So 8 weeks, 12 weeks, and 6 weeks. So that's almost half a year. The stock has not done much. But again, I would wait for the stock to make new highs and the volumes also to increase. And you could also see the stock's RS line also hitting a new high. Okay, Sharad, can you please repost your query, because I might have missed it. There are a lot of queries that are coming in. So there's one query which is pending on HDFC Live, and by the time Sharad you post your query, I'll quickly answer the HDFC query. Okay, so HDFC Life, again, one of those stocks which had broken out in April. So that's the time when the market had reversed and was doing well, but the rally couldn't sustain as the market condition was turned weak, and you could see. But a good sign over here is that the stock has been able to reclaim its 50-day line, so that's a positive over here. But as again, the view is same as Reliance Industries. Wait for the consolidation to play out. Wait, we never know how far the stock could, remain sideways. So wait for it to play out. Also, the relative strength line is picking up, but is still far away from its all-time high. So once the stock, reclaims its previous highs, once it breaks out into new high ground and the relative strength line is also moving up, maybe that could be a good time. But also, you would like to see volumes also picking up, and there's accumulation which is happening over here. Okay, so Sharat's query is on Nucleus. So doesn't look too convincing in terms of EPS rating. Price strength is also poor. It's a avoid for me right now because it's trading below its 50-day and 200-day lines. And also the fundamentals are not that great. Okay, so one query is from Achal. How can MarketSmith India help in generating alpha in stocks? So Achal, as you must have seen with our today's webinar also, the focus of canceling strategy, the focus of MarketSmith India is always to find the leading stocks, is always to find those stocks which can lead the rally in the markets, and that's where you can use MarketSmith India to generate alpha. Because using this strategy, what you will be doing is that you might cut losses in few stocks, but those stocks might be those which are not working right now and could build base patterns and could consolidate for a long period of time, and instead focus and deploy your capital only on those ones which are looking strong, which are leading the rally. So the proprietary ratings of earning strength, price strength, buyer demand, industry group rank, master score, I think all those will certainly help you in narrowing down your watch list quite quickly and only focusing on those which are expected to lead the rally in the market. Okay, so it's quite possible that I have not answered a few queries because of there were a lot of them coming in, and there's a time constant as well. So I would request you guys to drop in your query using the Ask MarketSmith feature, and we'll be happy to reply to them. And it was great interacting with all of you, and we look forward to you all joining in our next webinar on June 26th. Thank you for your time and appreciate you guys joined in today.